Hey, yo, what's going on right now? You're watching Casino is the name, and in this video, I want to talk to you guys about how you can use your 401k to pretty much be a bank, or how to turn yourself into your own bank. All right, now how do you do that? Okay, first of all, most people don't really know how their 401k works. They hear 401k loans and they automatically think, oh yeah, but you have to be going through something to take a 401k loan. Now, depending on the company, some companies that may be the case, but most companies allow you to borrow against your 401k and not just as a hardship. Now, if you do a hardship withdrawal, then yes, you're going to get hit with all the penalties of pulling your money out early, all the taxes, all of that kind of stuff, which is the whole reason why we're putting the money in our 401k in the first place, is to lower our taxable obligation, as well as to let the money grow without taxes already being taken. Now, if you want to use a Roth IRA, then they'll go ahead and pre-tax that money, and the money that's put in that account will be post-tax. But this is the main reason why we want to put money in our 401k, is to prevent the taxes. So if you want to have access to that money, you typically would have up to 60 months or 5 years to pay that money back without receiving a tax penalty. So this is how you can use your own money or your own 401k plan and become your own bank. When you go to get a car, let's say there's a car, let's say it's $10,000. And I'm not talking about a new car, but let's say you find a decent used car. It's like $10,000, okay? So you find this car, the bank is saying, well, it's gonna be this such and such interest rate or whatever. Instead of borrowing the money from the bank, which is the same process from borrowing the money from your own 401k plan, except for you're going to get instantly approved, of course. But you borrow the money from a bank and the bank says, okay, pay me back at 10%, 7%, 9%, whatever it is. Some of you guys may have 15 and 20% interest rates on your cars, but let's say it's 9% interest. You can borrow the money from yourself. Let's say right now, I was looking earlier today, if you took the money from the TSP, which is basically the federal government, if you're a federal employee, TSP is basically their 401k plan. And so if I was looking today, if you took a TSP loan today, you have to pay it back at 4%, right? Now, the 4% interest that you're paying back, that is your own money, right? So when you're paying that 4% back, that 4% you're paying back is actually being paid back to you. That will go towards your own account. That won't go into some TSP bank loan fund or some kind of fund for the TSP outside of your own money. So that 4% that you pay back is actually you paying yourself back. So not only are you not paying the 9% or 7% to the bank for borrowing the money to get that car, but you'd also be profiting 4% because you're still paying 4%. Well, you're paying 4% back, but you're paying it to yourself. It's a win-win, right? So what is the spread? Because you could either be going down negative 9% to money that you won't ever see, won't ever get back, or you can be going up 4%. And so that's a difference of about 13%. Depending, like the way I look at things, you know. By the way, I'm an accountant, you know, so of course, everything I see, I just see numbers, right? And so if you were dumping, then you could put up to $23,000 into your 401k plan per year. It's like 23,000, maybe 500 or something like that. It goes up every year, but it's at least $23,000 that you can put into your account to tax defer. So you can, if you make $100,000, you put 23% in, that lowers your taxable income. So the government only looks at you like you made $77,000. So, but you still have access to that money. So any kind of bank loans, any kind of things that you might have financed, you can actually finance it from yourself and benefit from the difference. Because you can say, well, maybe my account is getting 12% interest. Let's say your account on average, I want to say that I have to look it up. You can look up the S&P 500. Look up the S&P 500 and what it's averaged over the last 10 years. Now, let's say it's averaged 12% over the last 10 years. That's basically if you have your money in your 401k plan and the fund that you're investing in, say like the S&P 500 fund, then if you're investing in that, then yeah, you could say, well, I could have been earning 12% interest on my money. That's true, right? That is true. But you could also, in a situation where it's a 9% interest or something like that, you could also benefit from saving on the interest that you're paying out and also saving on or profiting from the 4% or whatever the interest rate is at the time that you're paying yourself. So when you add that 9% plus that 4%, you end up over 12%. You had 13%. So it would actually make sense to do it that way. Even if a credit card, if you're putting $10,000 and $20,000 into your retirement account, and of course, I'm not speaking on the matching portion. You automatically got to put 5% in because that's a no-brainer, right? Because they're matching more than likely 5%, some companies 6%, some companies 3%. But whatever the matching is, you got to put that in because you're automatically doubling. But beyond the matching, you put $23,000 in yourself, lowers your taxable income, and you, instead of having to use a credit card or instead of having to use a bank loan to get a car or something like that, you can use your own money and pay yourself back and profit from you having your own money. You can profit from using your own money. You basically turn your account into a bank. You turn your own money, you become your own bank with your money. Now you pay the money back out of your check, or maybe you could just write a check and put the money back in whenever you have the money saved up, but it's your money. And you'd be paying yourself back instead of paying somebody else back. That's basically the style in which that I will be doing everything kind of moving forward. Now, let's say all in all, you are going to retire and you're going to have at least $1 million in your 401k plan, right? Now, this is me. I'm just analyzing my own situation now. Let's say, worst case scenario, I have $1 million in my 401k, right? Worst case scenario, I have $1 million in my 401k, which is not a difficult thing to do when I get ready to retire, right? So when I think about $1 million, $2 million, whatever it is, when I think about that, and I think about what life will be like in retirement for me. Can't speak on everybody else because my situation may be very different from yours, but in retirement, I'm looking at minimum $1 million, but let's say it's $2 million, right? Well, you know what? Let's just use the million. Let's say I got $1 million in retirement when I'm retiring, right? I'm also a disabled veteran. I get 80% from the VA, so I get another like 2,000 and something from the VA. So I get that per month. Plus, I'll have my house. This house will be paid off in less than 30 years. So at retirement, this house will be paid off. I won't have any debts, no credit card debts, no car notes, won't have any of that because those things will have been paid off and pre-planned. You know, when maybe I'm about 5 years out, I'll start saving up the money to maybe buy a car, cash or something like that, or just something that maybe 2 cars, have enough money for 2 cars by that time. But either way, I won't have any debts when I get ready to retire. I won't have a mortgage. I'll have taxes, maybe, unless I'm 100% disabled veteran at the time where I won't have any property taxes. I'll have taxes, maybe. I have over $1 million saved, and I'll still have my VA check coming in. My thing is, let's say I plan to retire in maybe 18 more years or so, 17 more years, something like that. Let's say I plan to retire in 17 more years or less, but right now, 17 more years, and in that period of time, if I retire with $100,000 less than, say, $1 million, so if I retire with $900,000, because over that period of time, maybe I used $100,000 out of my 401k to do things. My son needs a car, my mom needs a deck put on her house, whatever it is, and I borrow $100,000 from my 401k, which I still would have to pay back before I retire, right? But if I borrow $100,000 from my 401k, which is borrowing it from myself and I'm my own bank, and let's say I just end up earning less money on that money just because it wasn't actively being invested or whatever it is, right? So even if I ended up with $100,000 less, but I'm still at $900,000 in retirement with all these things paid off, and it could facilitate an easier life because I was able to, I want to remodel my bathroom. I'm gonna throw $10,000 at that. I'm still paying myself back, so I'm still profiting from it. But even if I don't get a chance to profit from the 20% years where the S&P 500 does 20% or 15, on average, it's probably averaging somewhere around 10 to 12%. But even if I miss out on some of those years where it just did crazy in a year, 17%, which is a crazy number, even if I miss out on some of those things and I end up $100,000 less, that to facilitate life to be easier, to have a higher quality of life. You know, like I was saying, my son wants a car and I'm gonna go take $10,000 out when he turns 18, when he turns 22 or something like that, when he graduates. I take $10, $15 or $20,000 out and I go buy him a car. Say like I said, my mom needs something, or I want something around here. I want to put a fence up. That's going to be $5,000. Instead of me borrowing that money, if I don't want to say, okay, well, I'm just going to wait until I earn the money and save the money until I buy the fence. If I just decide, you know what, I'm going to go put this fence up right now. I'm going to hit my TSP up, my 401k up, and just get that money right now. If I do that, and I miss out on some of those crazy years, and I still end up at $900,000, even though it is $100,000 difference, I enjoyed that $100,000, in my life. What's the purpose? I almost feel as though, what is the purpose of me having $1 million or $2 million, $3 million in retirement, but I've not lived comfortable up to this point? If I don't have $3 million and I got $2 million, like if I was gonna have $3 million, but I only end up with $2 million, is that $1 million difference? Yes. But I also enjoyed that $1 million during the time frame that I was still working or still doing whatever that made my life a lot better. So I just find it at least something that we should, I don't want to say we should discuss, but just something that people should discuss when thinking about life and savings and retirement. Because I definitely believe you should have a retirement, right? But I think we should also assess, what does retirement really look like? This house will be paid off. Now, right now, this house is worth $400,000. I got about $200,000 in equity right now. But like, in retirement, this house will be worth $400,000. Would I could sell it? Well, right now, it's worth $400,000. Let me rephrase. But in retirement, it'll be paid off, and it'll be worth even more money than what it's worth right now, right? And then my retirement accounts will have at least $1 million or $2 million or whatever in it. But if I walked away in retirement and I got $3 million, and instead of having $3 million, I have $2 million, but I've enjoyed $1 million of that money doing things to facilitate my life, to make my life more comfortable while I'm still in my work life. I feel like that is more than worth it to me, because I still have millions of dollars with no debts. I think that's more than worth it. That's my opinion, of course, and I'm sure some people will feel differently about it, but if you got a credit card that's 20% and you're like, you know what, it's a $5,000 credit card, should I take the money out of my 401k plan and just go ahead and pay that card off? You save on that 20% and you also gain 4%, so it's really a spread of maybe 24% if your credit card was 20%. And you're profiting because you're paying yourself back 4%. It's really a 24% like difference. That's huge when it comes to the long term of your life. Anyway, I just want to come on here and talk to you guys about that. Right now you're watching Casino as a Name. If you find any value in this video, please like, share, comment, and subscribe, and we out. There are hedge fund managers making $1 million an hour. You know, it's crazy, right? It's money everywhere. It's money in everything. I want to help you. Start your business today. Come join my royal family. Subscribe to Casino as a Name.